Hi, Tori Agler with McIlvaney Precious Metals with your 2024 retrospective look. It's always good to look back and kind of see what transpired and certainly lend a little credence and confidence in our portfolio diversification. But also, we'll take a little bit of a glance into 2025, and I'll tell you some of my concerns and some things to look for. And as always, certainly want to share the screen with you so I can show you some of the visuals that go with the summary for the year. And first of all, it was a very good year for gold and a very good year for silver. So it's fun to give a report like this. This is not something that we would expect every year. Gold averages about 8.5, really to almost 10% returns per year. Silver kind of writes its own story, and a lot of times they're disconnected. But the biggest takeaways, the storylines in our market for 2024 is that we did set an all-time high in gold. Silver had a very strong rally. There was a lot of pre-election uncertainty. And then coming out of the election, there was a lot of post-election optimism. So we saw the metals prices move in different directions. Geopolitical tensions certainly remain a common theme for 2024 and so far in the start of 2025. The debt and deficits are the biggest story, and that is coinciding with the US dollar index rally despite rate cuts. And so we'll show you that. But the gold price, with opening around 2066, and we saw a high of 2007.91. We finished up 27.2% in 2024. Silver finished up 21%. At one point, silver was much stronger, up over 40%. On the year, and it opened at just under 24. It closed at just under 29, and it hit a high of just under 35. So anyway, a really exciting year with a lot of volatility for silver. Platinum and palladium were the laggards. Platinum finished down 8.7%. Palladium finished down 17%. We have not been selling any palladium here in the last few years. We've been focusing on platinum in terms of this sister metal relationship. And we will look to swap out of platinum into palladium when we see platinum get maybe twice the price of palladium. And with the way that the year ended, you'll see here they essentially closed at parity with each other in the low 900s. And so we'll keep our eyes on that. That's sort of a brief recap, but let's get into the technical analysis, which is looking at the charts. Gold had a higher close in 8 straight months. So that was a really fun run that did end up petering out right at the election time. So post-election, we end up seeing about a 9% drop from peak to trough. It did rally back a little bit, which is pretty common. And then it closed in weak fashion, which is also typical into the end of the year. There's in real strong years with gold, there's a lot of profit taking. There's portfolio diversification, and so we end up seeing sort of this fade into the close, and that's okay. But you'll see post-election that the peak had occurred, and we ended up dropping and then kind of limping into the end of the year. But we loved the 8 straight months. Silver, likewise, it's not as pretty of a chart. Gold is a little bit more interrupted, but you will see this red 200-day moving average. That's still a steady climb. The blue is a 50-day moving average. It's starting to turn down here because of the last quarter where silver actually finished in the red for the quarter and again limped into the end of the year, closing below 30. So what we saw, though, is about a 59% variability between the low of 2190 and that high of just under 35, about 3490. And that is a huge variability in 1 year in silver. And so we'll see if we can continue that trend and make some of that back up. I feel pretty optimistic about the white metals because they need economic viability, but they also need, not just that vibrant economy, but inflation. And I think both of those are certainly 2025 tendencies. Here you'll see the platinum relatively flat moving average here, but still somewhat in a climbing mode. And I'm encouraged by platinum. It could certainly be a lot weaker. It could look like this chart, the palladium chart, with that real strong decline in the moving average. It's not that I don't like palladium. It just got, very, very overvalued, and the market is moving away from palladium into platinum for things like catalytic converters. And so, again, like I said, we'll be watching that ratio. Here's the main ratio, though, the gold to silver ratio. You'll see we did have some volatility, but not enough. Look at this red moving average line for 200-day. You couldn't make it more flat. essentially, and so right around 84 to 1 is kind of where we averaged all year. And we did close the year right on the 31st. We crossed the 90 to 1 threshold again, which you'll see we did a couple other times in the year. But that low of 73 and that high of 90 is just not enough for a ratio trade. I'm really hoping that 2025 affords us the ability to see a trade out of silver into gold, that silver finally gets its rally and we trim some of our silver positions because I am a gold bug. And as you'll know, I mean, I feel like gold always, silver sometimes. And this is one of those sometimes. And here's why, because these yellow dots represent every time, the last 6 times anyway, that we hit 90 to 1. Well, you could draw a seventh one now because closing the end of the year, we hit 90 to 1 again. And that's fine. You'll see that that tends to be a real strong threshold that's hard to break through, with the exception of COVID, where we got all the way to 125. But what these blue boxes represent are the subsequent rallies. So the smallest rally was the second half of 2024 with 26% gains in silver in the subsequent months. You're talking, 2 to 6 months that we see these rallies. The high was 79%, again, post COVID. So just banking on the fact that, history repeats itself, I feel very good about positioning in silver here because the ratio hit that. Silver came down under 30. And I'll close with some recommendations and talk about that again. Here's the US dollar index. It's the last chart I'm going to show you, but you'll see that, again, going into the election, the dollar started to rally. I think there was some prediction in who was going to win, but also this corresponded with the Federal Reserve starting to cut rates. And, that's actually weak dollar policy. You wouldn't expect the dollar to rally, but relative to other currencies, it was kind of a bolster and a vote of confidence in the US dollar. But all that being said, once the election hit, it had started to turn down, and then it really rallied, and we closed the year at 109, which is incredible. To me, it could go higher. To me, it also feels like it's going to go lower. That there's not a whole lot left in this sort of a rally, especially when the reality sets in that the new administration has a tightrope that they need to walk, where they're cutting spending. That could certainly help the dollar. But if it results in a deepening recession or depression, I'd say we've been in a recession for all of 2024, certainly stagflation. And so there's going to be some, tricky maneuvering here where the dollar can go down. That would actually be good for gold. And again, we'll keep our eye on the US dollar because it's a direct impact on the gold price in the United States. So analysis of the fundamentals. So that was the technicals. That's looking at the charts. What do we see in the underlying fundamentals? There are so many that push and pull on the gold price. Okay. And some of these obviously affect silver as well. But, when each of these can, have a counter trend as well. So if there's economic viability, well, that's great. There could also be economic stagflation, okay, political stability versus instability. So some of the key things that I see coming into 2025 are some stronger economic setups. We'll see what the administration actually comes out with as an economic plan. Certainly, we see more political stability. It's not an election year. Geopolitical tensions are staying. The money supply will continue to climb. And as the money supply goes, so goes inflation, which I'll show you in a bit. And so goes the gold price higher. Inflation, US dollar index, I talked about monetary policy, spending versus tightening. We'll see what Washington's able to do. But that government spending is the key component to me with money supply and with inflation, and certainly keeping the dollar debased or devalued, depreciating, right? And that drives gold higher over time. The debt, we're now at 37 trillion, right under 37 trillion in the national debt and counting. Central bank gold buying was very strong in 2024. I think that'll continue. The bond markets tell the real interest rate story. The Federal Reserve doesn't control the bond markets perfectly. They kind of control themselves. And we've been in an everything bubble, which goes with the stock markets also. And the stock markets have been on a tear and getting overdue for a correction, which I'll show you here in a little bit. But the interest rates, the Federal Reserve does expect to cut rates 1 or 2 more times in 2025, which actually is not something that the market was real excited about. and also cause a little bit of a reversal in the dollar. So we'll see what the Federal Reserve does with interest rates, but they need to stimulate, and I think that they'll try to cut one or two more times. And then finally, speculation, fear, greed. When those enter the market, certainly anything can happen in any commodity. Okay. But I want to talk about the Federal Reserve balance sheet here a little bit. You'll see that it's turned down here in the last couple of years, and it's resumed its fall. They exceeded 9 trillion on the Fed balance sheet, but in the last quarter of 2024, we saw the most the most of a reduction in bank assets or bank reserves, over $320 billion. And so that brought bank reserves down under 3 trillion for the first time in 2.5 years. So we'll see what transpires there. If that continues. But that's quantitative tightening, and they did this in Trump's first term as well, much to his chagrin. It is economically stifling, and that goes hand in hand again with the fact that we've been in a recession, in my opinion. Central bank purchases of gold. Here's the blue line. You'll see that central banks have really ramped up their gold buying. Okay, and what has happened? Foreign central banks have reduced their U.S. Treasury and U.S. bond buying. Okay, so we're not getting those foreign buyers of our debt, which means our own Federal Reserve has to be buying its debt. The U.S. Treasury has to borrow in order to keep funding and keep spending. And here's another good image. So before the Ukraine-Russian conflict kicked in, we had 118 tons per year on average of central bank gold purchases. Then it really jumped to 291 tons. And this had a lot to do with currency wars and kicking Russia out of the SWIFT system and some of the sanctions that the United States did against Russia and some of its allies. So, this is, again, a trend I think will continue. And then the monetary expansion trend will too. 5x growth in the money supply over the last 20 years. No wonder that we've had prices double. The real inflation rate in the last 10 years is 100% increase, meaning prices have doubled. The cost of living has doubled for us all. And again, unfortunately, this money supply I don't see reversing, because if you're going to tighten spending, you have to depreciate the dollar. You have to debase the dollar in order to not drive us into a depression. U.S. Treasury bond issues, unfortunately, we're not at war. Fortunately, we're not. But unfortunately, in a year that we're not in war, we had this record borrowing, okay? And we're not even in a depression. So what are we doing? Well, we borrowed $2 trillion, and that's out of control government spending, quite honestly, with the present administration. So that's more than the financial crisis. And this is something that cannot continue because, again, it's driving us further into debt. But those bond issues are what enable us to keep on spending as if there's no need to be responsible. Part of the stagflation and the economic downturn, which has to reverse in 2025, and this is a key thing to keep your eyes on, is housing. Housing is just stuck. So we sold just over 4 million homes in 2024. That's the lowest number since 1995, even lower than the financial crisis, the housing crisis of '08. We have not seen those numbers since '95, and I'll tell you why. It's frozen is that you've got 50% increase in home prices since 2020, okay, which makes home prices obviously that much less affordable. But over the same time period, mortgage rates have tripled. Okay, and even with the Federal Reserve cutting rates and trying to stimulate, the 100 basis point increase in the 30-year mortgage is the reality. So that means the 30-year mortgage is up 1% since the Fed started cutting rates. It's back up over 7.1%, and that doesn't bode well. They've got to figure out a way to let housing loose. Housing prices need to come down. Certainly, borrowing rates need to come down, and that will certainly help the economy. And we'll see what the Trump administration does. The stock market, however, is at an all-time high, and so we're seeing values, which is price to earnings ratios, very, very high. So over half of the companies are over a 20-to-1 PE. You'll see that when that happens, every time we cross this line or touch that line, it actually doesn't bode well at all. It actually means those PE ratios are going to come down. So if they do come down, that's means, obviously that the stock markets, all the indices are at an all-time high. 50%, like I said, over 20, that number's got to come down. But here's the other two key numbers. Corporate insider buying, like those who are buying their own shares, are at the lowest level since 2010. They know that they're overpriced. In fact, 92% of all insider trading was liquidations in 2024. So those that are in the know are selling their own stock. And again, another indication that the stock market's oversold. Here's a great inverse relationship to show you. Again, we have to see how things continue in 2025. But if the labor force participation rate continues to decline, that means we're going to borrow more. So in order to stimulate, because there's not tax stimulation and GDP stimulation, there's borrowing. Okay, and we borrow and spend our way out of recession and depression. And recession and depression obviously leads to labor force participation rates dropping, and labor force participation rates dropping lead to recession and depression. So we need to see if these start working towards each other and start to cross again in 2025. So what are my recommendations going into the year? Focus on some key things. Focus on the debt. What are they able to accomplish with the debt? Okay, the bond market again sets its own interest rate policy, and if the bond market bubble bursts, that's the mother of all bubbles, and doesn't bode well for the U.S. dollar. The inflation and the U.S. dollar debasement, that's something, again, I feel strongly is going to continue, and that's why I remain a gold bug. And, if silver can rally as a result of economic growth and inflation, then that could, follow suit with gold. But I am very optimistic and very bullish on the long term with gold. Watch the gold to silver ratio and premium. So like I talked about, the gold to silver ratio is, back up close to 90-1. It's a really good opportunity to be adding to silver. The premiums as well have never been lower in our company's history. So junk silver right now, for example, is the same premium as a big 1,000-ounce silver bar. And we've seen the junk silver premium exceed 40% over spot. Right now it's at 1.1%. So it's a great buy. It's a great way to go into 2025. Again, the objective will be to sell it and move into gold later. I'm a gold bug, buy gold always, but sometimes we use the silver to do that. And we can also profit above and beyond the silver price with the premium coming back to life in the junk silver. So as always, just really appreciate you. You've got our contact information. Eric and Deanna and I would love to hear from you. We would love to help you out going forward. Please call us if we can get you a portfolio summary or an update. If you've got any address change or email change, let us know that as well. But as always, the best number to call is 866-211-8972. We wish you and yours a very blessed 2025 and really look forward to continuing in the relationship. Take care.